Assalamualaikum warahmatullahi wabarakatuh. My name is Noradlina Binti Redzuan. Today, I will present the pool expectation theory. In this theory, the term of structure of interest rate that view bonds with differing maturity as perfect substitutes. So, their yields differ only because short-term interest rates are expected to fall. Then, the market participant in this theory will buy and sell securities in order to maximize the profits. Long-term and short-term securities are perfect substitutes, and there's no transaction cost in shifting between short and long-term securities. The theory says that interest rates on a long-term bond will equal an average of short-term interest rate that people expect to occur over the life of the long-term bond. Bond buyers do not prefer one maturity over another. They will not hold any bond if its expected return is less than that of another bond of a different maturity. So, this is the formula to calculate the pool expectation theory, which R stand for the interest and N for the year. So, from this theory, we can simplify that short-term interest rate will determine the interest rate on longer-term bond.
Hi, my name is Nurul Izzatie Binti Mohamad Rosdin. The illustration of pure expected theory is, let's say that the bond market provides investor with a 1-year bond that pays a 9% interest rate, a 2nd-year bond that pays a 10% interest rate. And there are two strategies, which is, first, the investor buy the 1st-year bond and reinvest in the 2nd year, or the second one is the investor buy the 2nd-year bond. If the investor follow the second strategy, the investor will earn 10% per year. In order to get a similar yield using the first strategy, the investor have to reinvest at 11% in order to get an average of 10% using formula 9% plus 11% divided by 2. This is because bonds of different maturities are assumed to be perfect substitutes. Therefore, the expected return must be equal. Thus, we can conclude that short-term interest rates are a portrayal of longer-term securities.
Hi, my name is Nurain Amirah Binti Zai'in. So here are the summary of the pure expectation theory. First, if market participants expect the short-term interest rate to increase, the yield will be ascending. And if the yield descending, the interests are expected to fall in the future. Okay, next, the yield will be flat if the interest rates are expected to remain unchanged in the future. Then, if the short-term interest rates are expected to increase, then fall in the future, the yield will be the humbled like this. Expectation theory explains fact 1 that interest rate on the bonds with different maturity move together over time. Historically, short-term interest rates have had the characteristic that if they increase today, they will tend to be higher in the future. Hence, a rise in the short-term rates will raise people's expectation of future short-term rates. Because long-term rates are the average of expected future short-term rates, a rise in the short-term rates will also raise long-term rates, causing short-term and long-term rates to move together. Okay, this theory also explains fact 2 that yield curve tend to have an upward slope when short-term interest rates are low and are inverted when short-term rates are high. When interest rates are low, people expect them to rise back, thus yield curve will slope upward and vice versa.
Hello, my name is Siti Hidayahtul Solehah Binti Mohamad Ismail Selloo. I will explain about market segmented theory. This theory is at the opposite extreme to the expectation theory. There are two assumptions under this theory. Firstly is short-term and long-term securities are imperfect substitute where it traded in different market. Secondly is the process of demand supply in separate market where long-term and short-term will determine the shape of yield curve. Then, bond of different maturity said to be imperfect substitute because investor have strong preference of bond for one maturity but not for another, so they will concern to the expected return only for the bond with maturity they preferred. For example, short horizon investors such as commercial bank consist of short-term deposit will prefer securities with short-term maturities. On the other hand, long horizon investors such as insurance companies and pension fund will prefer security with long-term maturities.
Hi and Assalamualaikum. My name is Nurul Binti Tajudin. So I will continue with segmented market theory. If investors prefer bonds with shorter maturities that have less interest rate risk, the theory can explain factory that yield curve typically slope upward because demand for short-term bonds will increase, raises the price and reduce interest rate for short-term bonds, while demand for long-term bonds will reduce, decrease the price, and raises the interest rate. Fact 1 and 3 cannot be explained because of the assumption of imperfect substitutes. There is no relationship or influence between short and long-term bond market. Next, we go through the yield curve, which is the result of segmented theory. An ascending yield shape implies that investors have a preference for short-term securities rather than long-term securities, which is considered to be a bad sign of economic, such as predictor or recession, while a descending yield shape implies that investors have a preference for long-term securities than short-term ones. This is natural occurrence due to the increased default risk associated with longer investment time periods and a sign of expanding economy. A flat yield shape implies that investors have no preference for long-term or short-term securities. This is considered to be a sign of economic transition, either from a recession to an expansion or vice versa. That's all by me. Thank you.